Welcome to the Property Podcast, where great minds in real estate get together.
I'm thrilled to be joined by Harsh Kumar, co-founder and managing partner at Wealthiest Financial Services and author of the book Suicide Note of the Father of Punjab. Thank you so much for joining me today.
Pleasure is mine, Anjana, and good to be talking to you.
I'd love to hear more about your role as the managing partner at Wealthiest Financial Services.
We are a boutique wealth management firm in Bangalore, based out of India. And I'll just take a step back and tell you how India's wealth management space is. On the top, you have family offices where if you have sufficient wealth, you can hire people, you can have a set of people working for you and managing your finances. Then at the bottom, you have banks taking care of retail investor, affluent investors, but there's a middle pie, which is neither retail nor ultra HNI. It means, a bracket between $1 million to $30-40 million. Now, this is a particular bracket which we have as our clients because they want personalized services. And we give them a personalized service in terms of not just wealth management or investment management, but taking care of different elements of their finances as well. So that's how India's wealth management space is at the moment. And like I mentioned, that we figure in the middle one in terms of catering to our client segment. And our expertise is primarily across the board, be it Indian equities, be it offshore equities, be it commodities, real estate. We cover most of these asset classes. And then depending on what suits an investor's appetite and profile, we recommend them those investments. And then over a period of time, we analyze, track beyond investment. Suppose you have a bridge loan requirement in the short term, we give loan against securities. Suppose you have a requirement where you say, I want to insure my family, be it on the health side, be it on the life side, or any other risk transfer that one would need. We come in there also and we help that. So everything pertaining to an investor's journey with investment and beyond investment is taken care of by us.
That's pretty impressive. So how does your holistic approach to financial investment solutions incorporate to real estate assets?
So real estate is a very, very important asset class, and not just in India, but worldwide. Just to give you some data points, if I look at Indian investors, they have evolved a lot in last 15-20 years. But if I go back in time, most of the Indian investors would keep their money either in term deposit or in real estate or to some extent in gold. And there is a reason for that. Now, when you're an emerging economy, you don't trust capital market. So what do you trust? You trust something which you can touch and feel, which is real estate or precious metal like gold and silver. Or you trust banks which are either funded by the government or run by the government, or private sector banks which are way too big to fail. Now, in all these things, investors would either end up buying real estate or buying gold or, like I mentioned, term deposit stroke fixed deposit. Another dimension in a country like India is that people have affinity in terms of how their house is. So there are two big investments which an Indian investor would do, or I would say two big expenses in the life of any Indian when he or she starts working. One is buying an automobile, which is car, and second is buying a house of his or her own. And people don't just stop at buying one house for their consumption. They end up buying more and more houses. We didn't have paper form of real estate in the form of REITs and other instruments available in India till about a decade or so back. And then we started seeing those instruments in India. But even now, while we speak, we don't have a significant penetration of REITs in India. And we don't have availability also. So there are a handful of REITs which are available in India, but thankfully this market is developing. As per the recent changes by Security and Exchange Board of India, they have allowed even mutual funds which are equity based to invest in real estate investment trusts. So I'm sure with these kind of measures, the interest in these asset classes would go. Now, coming back to the question which you asked about the importance of REITs or real estate. Now, we all do understand that the primary objective of any investor is to beat inflation. And then comes the efficient frontier where you want to maximize your return at a given level of risk. And across the world, there have been times when there have been significant correction in real estate because of, overvaluation and other reasons. But it's a good hedge against inflation. And that's where we tell our investors that it should be a part of your portfolio, but it should not be a major part of your portfolio, because since India is moving in the direction from being a developing economy to a developed economy by, say, 2047, equity has a significant role to play in one's asset allocations. And I'm very happy to say that some of that money which was into physical real estate is now moving into capital market oriented instruments, which also have real estate as an underlying asset.
It's very interesting. So, what is your approach when working with ultra high net worth clients? How do you understand and serve their unique behavior?
I would say that India, or especially south of India, cities like Bangalore and all, investors are very reasonable. So when I say very reasonable, it means they want to understand the underlying logic on why they have made X return over, say, last 1 year or 2 years or 5 years or 10 years. How could they have improved their return? What are the risks which they ended up taking? What are the implications of those risks in the portfolio? Now, our approach, be it about ultra HNI or be it about HNI, is spending a lot of time in educating the investors and uncovering those behavioral biases, which at times even the investors may not know. Suppose I'm talking to you today, and if I want to understand your behavior with respect to your investment, there are two approaches. One is a very basic approach where I give you a questionnaire of 20 questions and I ask you to, fill different numbers, and I compute that and I arrive at what is your risk profile, be it aggressive or conservative or, somewhere in the middle. The other approach is I continue talking to you over longer period of time, maybe 5 hours, 7 hours, 8 hours, take you through different situations, understand what has been your reaction in those situations, which you have either been through or which could be hypothetical situations, and then arrive at something where we feel where your comfort lies in terms of taking the risk and what is your return expectation. And that's how this moves. So we often say that, there are two things. One is ability to take risk and another one is willingness to take risk. Now, there are investors who are 90 years old and they would say, I want to take equity exposure at 100% because all my needs are done with. Why do I need to keep money in fixed income? Now here, conventional ability to take risk is low, but the willingness is very high. On the other hand, we have investors in early 30s who would say, look, I want to be very conservative. I want to put my money into bonds and fixed income. And we tell them that, your age is on your side. Your skills will not let you deprive you to earn money. Why don't you take higher exposure in equity? So here, in the second situation, ability is there, willingness is not there. So as advisor, our role is to find a mix of ability and willingness, but understanding the investor's temperament. There's no point making 2% extra return, but having a sleepless night. So our first thumb rule which we follow at our firm is that all the investors and advisors should sleep peacefully. We don't want a situation of generating extra return by taking extra risk and then having high blood pressure. That's not the objective. Money is an instrument, but this is not the end in itself.
Brilliant. Okay, so what major shifts are you seeing in the global capital markets?
So if I just have to go by numbers, now Indian equity market ranges between say $4 to $5 trillion on different days when you look at it. The global market capitalization again ranges from 110 to 120 trillion dollars. So if I look at India as a percentage of global equity, it's roughly around 3%. If I look at countries like United States, it's 60 to 65% of global equity. Now, if an investor in India is only investing into Indian equity, what is he missing? He or she is missing 97% of the world, which can have opportunities which are not available in India or can have opportunities which are going to grow at a much better pace with much better fundamentals than what we can get in India. So that's the reason we feel that entrepreneurs are everywhere. Businesses or businessmen are everywhere. Some of them are very smart. Some of them are in India. Some of them are not in India. So just because a person is not running its business in India, just because an entrepreneur has its base in some other country, why should I deprive my investors of not taking exposure into that? So that's the reason we strongly feel investor in most of the countries today, even for investors in US, their market is 65% of the world market. They should also expose themselves to the emerging markets. It's very, very important in today's time that we should have diversification across the globe, because we can't have a home country bias where we feel entire growth or quality businesses are only in my country and nowhere else. That's very, I would say, short-term way of looking at things, but that's a very myopic approach to investment.
Great. So how does the Indian capital market compare to Western market, and how do you navigate your local market?
The size, India has grown up in size significantly. Now we are fourth to fifth largest capital market in the world. But the gap between the first market, which is US, second market, China, and then third and fourth is very significant. So one is Indian capital market has grown, but the size is relatively small. However, the ranking does not tell you what is the size. So that is variable or point number one, which we need to keep in mind. Second thing about Indian market is that Indian market offer very high return on equity, which is comparable to what we get in US, but nowhere else in the world. So you look at companies in Europe. I'm talking about index. I'm not talking about specific companies because there are companies in different geographies which have high ROEs and high growth rate. But otherwise, if I look at a broader level, the kind of growth rate which you get in India is comparable to what you end up getting in US. And that's the reason we feel India should be a part of everyone's portfolio, including your portfolio, because you can't get these ROEs and these growth rates anywhere else in the world. Another thing which is very interesting, which you would be very surprised, if I look at US market, the number of stocks trading in US has been reducing considerably. If I look at the data 10 years back or 20 years back and look at the data now, more and more companies in US have been going private. More and more companies in the US which are in the private space don't want to go public, and it's in front of you. I mean, today you look at companies like OpenAI, or you look at Elon Musk companies other than Tesla. They don't want to take it public because of the compliance and other reasons. On the other hand, in India, number of companies going public is significantly high. Today, the number of companies listed in India is higher than what it is in US. The number of IPOs which is coming in India is 20 to 25% of the world in any given year. The ideas are available, new opportunities are coming, which are not coming in European and American market. And thankfully in India, till now, the trend is for private companies to go public.
Let's move into a very interesting topic and talk about investor behavior. What are the key differences among American, Indian, European, Chinese, and even Japanese investors? How do cultural factors influence their decision-making process?
We have a lot of investors who are from US. We have a lot of investors from Europe as well. But I don't have any Chinese investor in my book. And I don't have any Japanese investor also. But we keep on reading about them. So some part of my reply would be from my practical understanding. Some would be theoretical. If I look at US, it's a consuming economy. They consume a good percentage of world. So the population to consumption in US, it's way too high versus rest of the world. So when you are a consuming economy, you are very highly leveraged in terms of, your behavior. Because if I look at credit cards, if I take a step back in US, when you go to college, you take loans for your education. When you go out and shop, you shop on your credit cards and all those things which are adding leverage. You buy automobiles, you leverage yourself. You buy houses, you take a mortgage, you leverage yourself. There is acceptance of leverage in that behavior. And when you are an investor with leverage as a part of your day-to-day life, your risk appetite is very, very different. On top of it, you have a social security element. So during COVID times, when government in US transferred X amount to different individuals' bank account, a good number of them ended up using that money to invest into capital market or cryptocurrency or any of those instruments, which doesn't happen in India. Because in India, since we have as an economy been from hand to mouth to developing, and we are yet good number of decades away from being developed, the first endeavor is, how do I protect my family? How do I protect my near and dear? So when I get money as an Indian, I would first want to secure the education of my children. Then I would want to secure the hospitalization expenses of my family. Then I would want to secure my retirement. And then I would want to think about spending and investing in relatively aggressive way. This is one difference between a US and an Indian investor. Now, let me compare Japanese investor versus the Indian investor. In Japan, this generation, which is now 35 or 30 or 37, they never saw a bull run in their capital market. If I ignore last 4 or 5 years, investor who invested in Japan in late 80s versus their return in 2010 or 2015, they would not have seen any return. Now, when you see that kind of a slow moving capital market, the excitement about the market reduces a lot for you. That would have a very different psychological impact, because when you go to those people and say that, why don't you invest in capital market? They would say that, look, in last 25 years, there has been no positive return. Why should we invest our next 25 years money into capital market? So that is about Japanese behavior. Now comes the Chinese behavior. It's a very different animal altogether because on one hand, you have government control on a lot of things. Even companies which were growing at a very fast pace were asked by the government or pushed to slow their pace because of various reasons, because they have their own agenda. In that country, capital market is fluctuating a lot because of government intervention. Individuals may say that, look, I want to invest into equity market, but let me find out other markets to invest in. Let me invest into US market. Let me not invest into only my market. So a Chinese investor is very open to invest into rest of the world because there is a fear of government coming heavily on ABC company and wiping away the return. Now comes a European investor. So if I look at, say, companies in Europe which have generated market capitalization over last decade or so, one is luxury segment. It has generated good amount of returns. Second is pharmaceutical because they have been creating a lot of innovative drugs at their end. Third is automobiles. Now, their investors, the behavior is more about today than what it is about tomorrow because A, you have social security. B, the lifestyle is such that you want to reduce the number of hours you work. You want to spend what you have today rather than keeping it for your retirement or those kind of things. So India that way is very different because here people save a lot by compromising their today for tomorrow. They save a lot for their next generation's education. They spend a lot for the children weddings, which is not the case in a lot of Western countries. Thankfully, now after COVID, a lot of people have started spending on travel and other discretionary items in a guilt-free way. But 10 years back, an Indian investor, when spending X amount, which could be a 15-day salary for him or her on travel, would feel a lot of guilt about it because he would have seen or she would have seen his or her previous generation struggling with respect to their finances. So I would say, if I have to summarize, investor behavior is a function of how you grew up. What was the kind of environment around you when you grew up? What were the fundamentals of the country when you grew up? If it is a fight for survival, if it is a fight for food, then your behavior would be to conserve. You would want to invest more into gold, more into all those kind of things, bonds, rather than going into spending into equity market and all. So I think there's a lot of conditioning involved, and that conditioning is a function of how one's upbringing is, not only by his family, but by the entire ecosystem around.
That was very insightful. Thank you so much. So, in your opinion, how well is the global capital market adapting to the ongoing influence of AI?
It's very interesting. Now, if you speak to experts, what are they saying? On one hand, there won't be job losses the way it's being predicted because when internet came, a lot of people thought jobs would go. It didn't happen. Jobs changed, but people didn't lose the job. Then when industrialization happened prior to that, jobs transformed, but the losses of jobs was not there. So that is one opinion, which is widely popular in the world. And I have my reservation about some parts of it. I'll explain those. Second, it's a lot of FOMO amongst the companies, which is fear of missing out in terms of the kind of capital spending these companies are doing. So you look at, top 4 or 5 companies in terms of their AI spending, the budget runs into $50 to $80 billion a year, which is not a small budget. I mean, you're looking at a significant part of US capital spending today happening on AI and not on anything else. So when you look at US GDP data and you look at capex numbers, it's not that people are buying houses. It's not that dams are being constructed or roads are being constructed. A good part of capex is now going to AI. When that kind of a money goes into that, there could be asset inflation which could happen. Now, I'm not saying that AI has no future on those kind of things. AI looks to be very, very promising technology. It is one of the path-breaking technologies of last, I would say, 30, 40 years. But the kind of spending which is going into that is creating a situation of FOMO. That FOMO is creating a situation of asset price inflation, which is the stock price inflation of these guys. And that is also creating a lot of linkages in the economy. So just to give you an example, Oracle announces its result. It says that $300 billion in next 5 years would be invested by OpenAI. OpenAI's top line for the year is $10 billion. Now today, a company's top line is $10 billion, but it is going to spend $60 billion. Another company is contributing to the revenue of other companies, which is 6 times its revenue. So how would that happen? They would raise money. Who gives them the money? NVIDIA gives them $100 billion. The business which comes back to NVIDIA is around $300 to $350 billion. So when you have these kind of linkages, if the story plays out really well, then These companies from $3-4 trillion market cap may become $30-40 trillion market cap also. Who knows? I mean, things can change. Who would have thought 10 years back that these would be $3 trillion, $4 trillion companies? But one disaster can lead to a spiraling effect in terms of a lot of companies losing their market cap. So we'll have to wait and watch. Coming to the first part, which I was mentioning about job losses, I strongly feel that market is underestimating the kind of job losses which would be lost by AI. Yes, jobs would be created. Yes, there would be transformation of jobs. But I strongly feel a lot of professionals may get redundant over a period of time. Right now, we are seeing some bit of plateauing in AI also. So if you see the last version of OpenAI and compare it to the previous version, difference is not exponential like the way it used to be. So we'll have to wait and watch. Can I be really assured that my profession would be intact after 10 years? The answer is no. What is the most common question in boardrooms today is about AI. Second, how many people will remain relevant? How many people need to be laid off? And there's a lot of socioeconomic dimension. There is a lot of political dimension to this. So we'll have to wait and watch. But it's interesting time. I think the early we embrace it, the better we would be.
Great. So what advice would you give to the investors out there?
My advice would be that don't underestimate it. So have some exposure there. Maybe depending on your risk appetite, 5 to 10% of your asset can be there. If that doesn't play out and it backfire also, then you would lose 50% of that 10% and your portfolio will go down by 5%, which can be compensated even by US Treasuries return over 13-14 months. But on the other hand, if the theme plays out the way it is being projected to be, then that 5-10% of the portfolio can grow up significantly also. Based on individual appetite, I would say that don't ignore it, but don't be over allocated to this. So AI doesn't mean that you should not have exposure to pharmaceuticals, you should not have exposure to banks, you should not have exposure to consumption, because AI or no AI, you would need food to eat. You would still use e-commerce. So those businesses, if they are available at a good valuation, make those as major part of your portfolio, and remaining part of the portfolio can be in AI.
Let's discuss your book, Suicide Note of the Father of Punjab. What inspired you to write it?
The toughest part is there are two tough dimensions of my profession. One is, how do we detach ourselves from the screen on a day-to-day basis? It's very tempting to see your investment going, 2x, 3x, and then, trying to track it on a day-to-day basis. Second is, how do we learn from other fields? How the profession of a doctor works? How a restaurant owner makes his money? What are the kind of ROEs? What are the kind of EBITDA those guys have? Since we need to have these two things, it is very important for us to detach ourselves from day-to-day life. There are two ways in which it can be done. One is by reading, another is by writing. Third is, of course, by experiencing, by traveling a lot. But there is a constraint to that. You can't travel 360 days a year, but you can read 360 days a year. You can write 360 days a year. That's what my idea was when I started writing. This is a story about a person from a rural Punjab. He's a villager and he tries to adjust to the life in a metropolitan, and the kind of struggle he goes through because of certain very superficial reasons. It's a humorous book to unwind, a light reading.
What message are you hoping to share?
My message for investors or for public in general is, don't have home country bias. Don't think that entire talent is in your family. There are people way too smarter who are outside your family, outside your country, outside your continent. Look at them. There's no harm in investing in those ideas. Rather, there is a merit in doing that. And lastly, money is an instrument. It should not become a reason for one to lose his or her health.
Who is the target audience?
Target audience is professionals. Professionals appreciate the professionalism of other people. A lot of people who have made their money the hard way, or they are first generational entrepreneurs, or they have made their money by their profession. Those are the kind of target audience which we have.
Where can people find and purchase the book?
It's on Amazon, so one can go on Amazon and buy the book.